So welcome to the second topic, banking, and the webinar series, What's Next? Pivoting from high school into your future. In this webinar, we explore the important role a bank or credit union can have that helps you manage your hard-earned money now and in the future. And our speaker, Mr. Devontae Montgomery, is going to be talking about the two most common and important types of banking accounts: savings accounts and a checking account. Amazingly, it turns out these two humble banking tools, a savings account and a checking account, can assist you in actually implementing your monthly budget, handling both your monthly income and expenses by providing a safe place to deposit your money and a safe place from which to withdraw money to pay for your monthly expenses. Additionally, we will be touching upon other important banking tools, including compound interest in growing your savings, an emergency savings account, SMART goals, and very briefly touch upon the difference between savings and investing. Our speaker for today's webinar, Banking, is Mr. Devontae Montgomery, a financial educator from MSU Federal Credit Union and the Oakland University Credit Union. He is a graduate of Oakland University with a bachelor's degree in finance, as well as a proud alum from Cass Technical High School in Detroit. And we thank and appreciate Mrs. Kohler and students for inviting us into your classroom today. So without further ado, here is Mr. Devontae.
All righty, thank you so much for that great introduction, Suzanne. Yes, my name is Devontae Montgomery. I am a proud alum of Oakland University, and my high school was Cass Technical High School. Currently, I serve as a financial educator for MSU Federal Credit Union and OU Credit Union. I'm excited to be here. And today we'll just be going over some different banking things. We'll get into, like Suzanne said, those two topics of checking and savings accounts. We'll touch a little bit on investing and how interest works for you. So without further ado, let's go ahead and get into it. So first, I'd like to talk to you about our Financial 4.0 app and website. This app and website is it's geared towards high school and college age young adults that really want to learn more about financial education. So we have different calculators and tools on there of budgeting and how much a loan could be. Also weekly articles, graphics, and videos on different types of pieces of financial advice that can really be good for you and good to learn, and really in layman terms where everybody can kind of understand. So if you search Financial 4.0 on your app store, then you'll see us there, or you can visit us at msufcu.org/FIN40. All right, so when we think about banks and credit unions, what are some similarities and what are some differences? You know, a lot of the times it can be definitely very closely related, but there are some differences between both banks and credit unions. So first, we'll go over the similarities. They both have checking accounts. We'll get into what exactly a checking account is, savings accounts, credit cards, mortgage, auto loans, personal loans, and your account is insured up to $250,000. So this is also why you may hear people talk about keeping your money in a financial institution instead of keeping it at home under the mattress or something like that, because your money is insured in the case that something does happen. If you have your money at home and you lose it, or there's a fire or something like that, that money is gone. You can't call the insurance agency and be like, hey, I lost, $1,000. I need you to replace that. That's not going to be something that they're going to be able to do. So that is also why, we encourage keeping your money in a financial institution. Also, branch locations. So those are those physical locations that you may see sprawled throughout your city or as you're driving along. ATMs, as well as debit and ATM cards. So with banks, they are insured by the Federal Deposit Insurance Corporation, so also known as the FDIC. This is the regulator and insurance agency for banks. They are for-profit companies, can be nationwide or international. There are lots of those bigger banks that you may hear, and they may have locations all over the world, and a lot of them can, of course, be nationwide. Has customers and a small group of people who are owners. So usually with banks, they are owned by investors, and the investors may not be the same people that are customers at those banks. Typically, the fees may be a little higher than when you compare them to credit unions, but that of course has to do with the fact that it's a for-profit company. But that's not always the case. Sometimes the fees are the same and sometimes they're less, but just on an average rate. And they do not share branches or ATMs and often charge fees for using some of those services. So when it comes to banks, because they often have more branches than a lot of the credit unions and things like that you'll see, they often only use their own network of those ATMs. And then in order to access money or get your money, like if you've ever been to a store and they have that ATM right there, get your money out of there, there may be a charge there in order to use it. So those are service charges that you may see. And then we have credit unions. So with credit unions, they are insured by the National Credit Union Administration, which is also the NCUA. That is the governing body, just like the FDIC for banks. Community-based, not-for-profit. So they're not-for-profit companies, which means they also have just a different type of regulations and things like that. But that's not really that important to this presentation. Has members. So when you, usually when you sign up with the credit union, there's something like a $5 deposit that is required in order for them to, open up your account, usually to open up that savings account. And with that, that turns you into a part owner of the credit union. So a lot of the times they hold different board meetings and things like that, and they try to include the public in those different decisions. And that's because the members are also the owners of the company. Typically, they have lower account fees and may share branches and ATMs with other credit unions. So that is what's called the co-op network. So the co-op network says, there are lots of credit unions around the nation, and a lot of them are only local. So in order to ensure that members of a lot of credit unions have access to their money, they opt to allow other credit union members to use their ATM services and even share branches, which means that you could go into the branch of another credit union and still do services that your other credit union, your home credit union may offer. All righty, so how do financial institutions make money? This is just a cool little graphic to really show you, how these financial institutions make money. So we'll say that this is a consumer, and this is a consumer as well. And then in the middle is the financial institution. So if we talk about the beginning of the diagram. So a consumer, let's say you deposits money into your financial institution. And then from there, the financial institution pays you dividends for allowing them to be able to hold on to your money. We will get into exactly what dividends are as we move throughout the presentation. And then we have financial institutions. They make loans to other consumers, or you could be that other consumer. So let's say someone wants to buy a vehicle. So they would give them a loan for that vehicle to be able to purchase it. And then in turn, every time that consumer makes a payment on that loan to the financial institution, they also include or are paying what's called interest. Interest can be defined as the rental fee for borrowing money. So when like let's say you get a car, you're paying that car payment, within that car payment, most of it is going to go to the amount that the car was actually purchased for. And then there'll be another amount that will go to interest, which is that rental fee. So that's kind of how financial institutions make their money, of course, through investments and other things like that. But as far as how consumers are concerned, this is how they make that. And then additional ways that financial institutions may earn money is through debit and credit card usage. So each time you swipe your debit or credit card, there's a certain amount that there's a certain amount that Visa or MasterCard may pay to that financial institution for, just swiping that card. And then also fees as well as investments. So now that we've got that out of the way on what financial institutions and how they make money and how that works, let's talk about the types of accounts. So the first type of account that's most often used at a financial institution is a checking account. So this can be seen as your spending account, which means that this checking account is tied to money that you earn. So let's say you're working and you get your paycheck. When your paycheck is deposited, most often it will be deposited into that checking account. And then that is called direct deposit, or an ACH can also be seen as that. Debit cards. Your debit card is directly connected to this account as well. So when you swipe that card, it's coming out of this account. And also personal checks. I know checks aren't as popular as they used to be, but they are definitely still in use. Personal checks that you may write, that will come out of this account. You probably won't use them a lot, but you may use them when it comes to like paying your rent or paying utilities and things like that. Checks also create what's called a paper trail. So you could definitely see like when this was deposited, when it was taken out, and all of those things. And then we have dividends. So most often dividends are not really paid on checking accounts. They may be paid, but those are for like money market checking accounts. And then those have different types of rules and things like that to them. But overwhelmingly, checking accounts do not have dividends. Yes, Suzanne?
I just wanted to double check then. So when I'm using my my debit card and when I swipe that through, then obviously what that's doing then is pulling the money out of my checking account, right? Just pulls it right out of there pretty much immediately then?
So there are two different types of things that you can do with the debit card. That is swipe as debit or as credit. So if a debit card is being swiped as debit, there's going to be that 4-digit PIN that is put in. So whatever the PIN is that you may come up with, that stands for personal identification number. When that PIN is entered, then that money is immediately withdrawn out of that account. If the PIN is not entered, then it is swiped as credit, or it can be seen as a signature-based transaction. And that takes 2 to 3 business days before it fully comes out of that account. Now, you may see when you swipe it that it is pending. And if it is pending, that means that the money has been, you swiped it for that amount, and you will see it settle in 2 to 3 business days. So there's that difference between, debit, swiping as debit and swiping as credit. But with the debit card, that money is regardless going to come out of that checking account. Did that answer your question, Suzanne?
Yes, I think so. So ultimately then the money, one way or another, it comes out of your checking account, whether it's debit, which is immediate, or as credit, then there's a time delay, but it all comes out of the checking account is what I'm hearing you say. Is that right?
Absolutely.
Okay, thank you.
Thank you. All righty, and then we have savings accounts. So with savings accounts, these are accounts that typically you're going to save money in, and that is why they offer dividends. So dividends earned. With dividends earned, this is the amount of money, like let's say, you put your money in your savings account and you don't touch it. You allow it to sit there. Dividends earned is just a small amount that financial institutions pay for allowing them to hold on to your money. Because as we saw in that last example, in the last slide, that when you are depositing money to them, that allows them to be able to loan the money out. So that is them thanking you and appreciating you for keeping your money with them. With the savings account, there can also be an ATM card attached. ATM cards are only like connected to those savings accounts. They're pretty unpopular. People don't really use ATM cards nowadays, but they do exist. And then there are limits on the amount of electronic withdrawals that you can have out of your savings account. So what electronic withdrawals mean is if I grab my cell phone and I go into my account and I transfer some money, that's going to be considered an electronic withdrawal. Usually if I call into like a call center and I ask them to, change around some money for me, that can also be seen as an electronic withdrawal. But let's say I go into a branch and ask somebody to transfer money for me. That's not an electronic withdrawal. Pretty much anytime you have to move your feet to get to, and get somebody to transfer or to do it at an ATM, those are not electronic withdrawals. But with that, Regulation D states that no more than 6 electronic withdrawals per month through a savings account. And that is because a savings account, the idea is that you're not supposed to be touching the money a whole lot. You can also have multiple savings accounts. With this, at my particular place of work, MFC Federal Credit Union, we have what's called sub-savers. And you can name the sub-savers. It really works for me. I have like 10 of them in my account. But they're all savings accounts, just, ones that I put in and I may name something like for bills and stuff like that. And there also are multiple types of savings accounts, and we'll get into that in the next slide. There we go. Okay, so types of savings accounts. Standard. Usually those are those savings accounts that people open up most often. They usually have low dividends. So they're not paying you a lot of money to really hold on to your money. Liquid, that when I'm going to say liquid a few times throughout our presentation, all that means is really just cash. So you can just go and get your cash out of there if you need to. But we'll talk more about how liquidity plays into investments and stuff like that as we get into the presentation. You can have multiple, we just talked about that. You can add money to them and may not have a minimum balance. So usually your savings accounts don't have a minimum balance. With the credit union, that $5 that you put in there, you really can't touch that $5. So I guess that can be seen as a minimum balance, but most often they do not have that. Yes, Suzanne.
So just so I understand, when you're speaking of a savings account being liquid, what I'm hearing you say is that pretty much means that the money is immediately available to you. You have to use your feet. I guess you could do it online as well, but you're able to get access to that money very, very quickly. There's no waiting period. Is that kind of a way to look at it?
Exactly. Yes.
Okay. All right.
And as we continue to move through and talk about the different types of accounts, liquidity will change on that. So that's also why we brought that up. Thank you for asking that question. And with the high yield savings accounts, they offer higher dividends. They also can be seen as semi-liquid because usually if you take out of those accounts, then maybe you won't be able to get your dividends, or they also may have a minimum balance. You can have multiple of those, and of course you can add money to them. When we're talking about high yield savings accounts, they're going to be a lot like the standard savings accounts, except for they offer the higher dividends, and it may not be as easy for you to get your money out. And for example, I have a high yield savings account, and it is with a financial institution that doesn't have any sort of card access or anything like that. I just transfer my money there, and if I need it, I have to transfer it back. And it takes 2 to 3 business days for me to be able to get access to that money. So that is what we mean by semi-liquid.
Would you say that the periods of time people leave their money in there, it kind of varies, like maybe a year or 5 years, or how many years?
That varies greatly based off of especially with these two, standard and high yield, but we'll get into certificates, which also have a requirement for individuals to leave that money in there. But there's not really a certain time limit or anything like that people really are.
With the high yield. Thank you.
Yeah, in the high yields and the standard savings accounts.
Thank you.
And then we have certificates. So they offer the highest dividends pretty much when we're thinking about those different savings accounts that exist. So they are not liquid. And this is because with a certificate, there are different periods that you can have a certificate, whether it be 6 months all the way up to 7 years. But that is a predetermined date that you would agree to. Like, let's say I get a 2-year certificate and I'm putting $1,000 into it. What that is saying is that I'm going to allow that financial institution to hold on to that $1,000 for 2 years. In return, they are going to pay me more dividends than if I had any of the other savings accounts. You can have multiple of certificates, and usually you cannot add money. But there are special products out there that allow you to do it. Like MSU Federal Credit Union has a 1-year add-on certificate where individuals can actually add on to the certificate throughout the year. But most often it's a predetermined amount that you would give to that financial institution and that agreed to date. Alrighty. And then, so let's go over debit cards as far as debit and credit. So we kind of talked about this. With debit, they are point of sale. That's also can be what that can be seen as. You put input the PIN, money comes out of account immediately, and there can be cash back options. So like if you've ever swiped your debit card and you see it, actually, do you want any cash back? That's what that cash back option is. They can be seen as less secure. And this is because we'll talk about what that is. So credit is no PIN when those signature-based transactions. You may not have to put your signature down because they may accept that electronic signature. Like let's say you go to McDonald's and you swipe your card. Most often you are not going to have to enter that PIN, and they're not going to make you sign the receipt, but they're accepting that electronic signature. Takes 1 to 3 business days to process, and also that money comes from your checking account, just like with the debit point of sale. And they can also be seen as more secure. So this is because with swiping your card as credit, there's a certain system that they're going to go through. If you look on the bottom right of your card, whether it's Visa or MasterCard, it's going to go through their crediting system. And that also ensures that transaction in case it is fraud. That's why, I said, keep that PIN to yourself, that personal identification number, because you don't want anybody to gain access to that. With that credit, there's no PIN that needs to be used. So if someone gains access to your card and they use that, then it is secured, and you will definitely be able to get your money back if the investigation does lead to them finding out that that was fraudulent. And also something to know, just because it says credit or you can swipe it as credit, it does not build credit history. So when you're swiping as credit, this is still a debit card. So debit cards do not build credit history. All right, and then let's talk about how does interest work. So I've mentioned dividends, and dividends are interest paid to consumers who leave their money on deposit. So when you're leaving that money in there, and that small amount that financial institution that may be giving you for allowing them to hold on to it, those are going to be seen as dividends. Interest paid, this is charged for consumers who borrow money at a rental fee for using the money. Higher risk equal higher rate. And what that really means is that when someone is taking out loans for financial institutions, they're going to look at that credit history, whatever that credit score may be, and also what that credit report may say. will help to determine what the rate will be for those particular loans. So that's what that higher risk equal higher rate means. Rates are measured annually as annual percentage rate for those times when you are paying that rate, and annual percentage yield when you are earning the rate. So dividends are often paid monthly or quarterly, and interest is often charged or paid with each loan payment. So with the APY, or the annual percentage yield, that's when you are being paid dividends, and APR is when you are paying interest. All right, so what is compound interest? Compound interest is this wonderful, wonderful thing that really helps us out. It's on your side when you have time on your side. Really, that's what it looks like. So essentially, it is the interest that you earn on interest. So I'm going to kind of talk about an example of it, but I want to break down some things for you. So the principal amount. When we're talking about principal amount, I'm talking about the original amount that may have been invested, or the original amount that was paid for something. And then so we have simple interest plus, we have simple interest or compound interest. So with simple interest, this is just going to look at, the initial amount that somebody may invest times whatever that rate may be. And that'll be seen as simple interest. The compound interest says that whatever, let's say after a year, I earn a certain amount of money. And compound interest is really going to look at, you're not only earning money on top of that principal balance, but on top of the principal plus the interest that you earn. So that's what compound interest is going to look at. But we have an example, because I know that sounds a little confusing. All righty, so let's say for simple interest, originally we invested $1,000, and our return rate, or our rate that we're going to be getting back, is 5%. So that will be $50 per year if we're looking at simple interest. But then I have, let's say a compound interest, say a stock, and it is, or compound interest investment. So it is $1,000. That's that initial investment, or that principal amount, plus that rate of 5%. They both would earn $50 for that first year. But then something starts to happen in the second year for compound interest. So we have that 1,050 times now that's still that 5% rate. So if you notice, with up here with the simple interest, this is never calculated into the amount of interest that someone may be receiving. They just get that $50 every year. Compound interest, it's different. This person is going to now start earning more money than this person would, or this investment is going to start earning more money than that investment would. So that is for the second year. So then that person would have $1,102.50, and the other person would have $1,100. All right, so let's see what happens after 10 years. After 10 years, your investment will be worth $1,500. After 10 years with the compound interest investment, it will be worth $1,628.89. So as you can see, over the years, these start to definitely forge a gap between one another, and that compound interest is truly worth more than that simple interest investment. And then we have the rule of 72. So this really helps out when you're talking about compound interest. It gives you an estimate of how long it will take to double your investment based on the current interest rate. Now let's look at an example for that. So over here, like I said, it's 72, the rule of 72. So it would be 72 divided by interest rate equals number of years to double. Let's say someone deposits $5,000 today at a 2% interest rate. 72 divided by 2 will be 36. So that means that it'll take this person 36 years to double that investment from 5,000 to 10,000. But let's say somebody invests $5,000 at a rate of 8%. 72 divided by 8 will equal 9. So around 9 years for $5,000 to double to $10,000. So that kind of you can just illustrate and see what that difference in that is. And, you know, thank you to the Federal Bank Reserve of Atlanta for this infographic. I think it shows and illustrates this Rule of 72 very good. So if you're ever wondering, you know, how long is it going to take me to double this investment if I decide to give my money to this? These are things that you'll start to wonder and that you'll start to see become a real reality as you head into adulthood and when you think about setting yourself up for your future.
So the rule of 72 is what they call a rule of thumb. It's something handy that you can refer to and even do the calculation in your head.
Exactly. Thank you for that, Suzanne. All righty, and then the basics of investing. So let's talk about what is the difference between investing and saving. What's that going to look like? So one, investing can be seen as a form of saving because the idea is that I'm putting my money up for a later use. But that is pretty much where they stop being the same. With savings are usually more liquid than investments other than like that certificate. And savings accounts have an average rate of 0.05%. So those standard savings accounts, that's what their average rate is right now. With investment, this is putting your money away towards something in hopes that it will grow and be more than your initial investment. So we saw those examples in the last slide of what kind of how an investment can really help you or how an investment can really grow. The average stock market return is 10%. So we're looking at something that is 0.05% versus 10%. So there's definitely going to be a huge difference between the two. But with investments, usually it is a long game. So what a long game means is that when I invest this is going to be something I'm usually going to put up for quite a while. And something that kind of everybody can, kind of relate to or that's heard in the news. Let's say cryptocurrency, for instance. It's an investment, a very risky investment, and sometimes it can pay off fast. But overall, the effect of cryptocurrency or the growth in cryptocurrency can be seen as a long game when we look at things like Bitcoin. So Bitcoin started off at less, it was like a penny in 2007. Now, Bitcoin is trading at over $50,000. So that's just to kind of just think about how beneficial, investing can be. I'm not saying to go out and invest in Bitcoin, do your research when you're doing any investment, but you can see that it's kind of a long game for somebody that, let's say somebody invested $100 into Bitcoin in 2007, but they bought $100 worth of Bitcoin. If it was a penny, then what is that, 10,000? Yeah, 10,000 shares. And then they waited until now to kind of cash that out. That can be definitely seen as an advantage. Go right ahead, Suzanne.
I was going to say, I just applied the rule of 72 that you shared with us, and I divided 72 by 0.05 as the interest rate, and it will take 1,440 years to dump your money. But if we take the rule of 74 with a stock market return and an average return of 10%, that will take 7.2 years to double your money. So we see kind of of how effective that higher interest rate is with the stock market. But I'm sure also there is risk, right, Devante?
Absolutely, there's risk.
We got to balance that potential higher return with risk. Yes.
Sorry about that.
No. I'm.
So with the stock market, and savings. So this is also where they differ. If you remember when I talked about savings, I talked about insurance, the insurance that you may have, you know, up to that $250,000 for your money in a financial institution. So that includes that savings account, checking account, all those different accounts that may exist. But when you're thinking about investing, there is no insurance as far as your money goes. When you're investing, you could absolutely lose all of that money, or you could gain a lot off of what's being invested. Though historically, so that 10% return rate is a historical kind of return on the stock market. And historically, every downturn that the stock market has experienced, the upswing has helped to make up for it over the years. So that it isn't something that happens immediately, like if someone, you know, during the recession, if you can remember, I know you all were probably very young during the recession, but that back in 2008, 2009, a lot of people lost a lot of money in the stock market because of that downturn and because of the housing crisis, which has to do with a lot of investments and things like that. So if someone, you know, loses all their money in the stock market, there's not that insurance there that would say, you know, that would say your money is invested up to this amount. So that is also a difference between investing and saving. And then we have stock dividends. So we talked about dividends as far as how they're related to financial institutions, but with dividends as far as they're related to investing, this is amount paid by the company to owners for purchasing and retaining stock. So it's kind of just like with a financial institution, you allow them to hold on to your money, and in turn, they give you a little money back. It's the same thing with investments. You have invested in these companies, and in turn, they are some of them, because it's not everybody. Everybody does not pay dividends. So that's why I also said do your research. In turn, you buy that investment, you hold on to it, and in return, they give you a little money for holding on to that investment. Dividends are very small, and it's also dependent upon the formula that the company may come up with. They may pay 10 cents per share, or, you know, whatever that may be. And then we have capital gains and loss. Before I go over that, yes, Suzanne?
Sorry, I was going to say with those stock dividends, if those are paid regularly by the company, those can be used as a form of compounding.
Absolutely, they can be used as a form of compound interest. And what Suzanne is talking about is those dividends being paid. Some people opt to receive all of their dividends, like just receive the money in their accounts, or they opt to have it reinvested into the stock market. So, you know, if you're going to pay me that 10 cents per stock, let's say I own one share, just add it to my share, and that way I'll start to own more and more shares, or more and more of that company. And then we have capital gains or loss. So capital gains or loss is the amount of profit or loss achieved from selling an investment. So I'm going to give you an example. Let's say my initial purchase of a stock is $10. And then a long time later on, I shouldn't say a long time, along at some point, I sell it for $20. Was that a capital gain or a capital loss? Give you a sec to think about it. That can be seen as a capital gain. And that's because you sold the stock or sold the investment for more than what you purchased it for. And what is going to be that capital gain amount? You would take the $20 and minus it from the $10, and the capital gain amount will be $10. So that's kind of how you can look at capital gain and capital loss. If it was the other way around and I sold the stock for $10 and I bought it for $20, it will be a capital loss of $10. Alrighty, so let's talk about some basic investment types. So a stock, this one is very, very popular. A lot of times this is when you hear people talk about investments, other than like cryptocurrency and stuff like that, a lot of them are talking about stocks. Stocks is the ownership of a company that may grow in value or earn dividends. So we just talked about what those dividends are and how you can earn them. So that is from owning a stock. And then we have a bond. A bond is money loaned to a government or corporation, and this also earns interest and may be worth more, but it's also going to look at the value of it. So this is when you're thinking about a bond. Let's say I have godchildren, and what I do is on their birthdays, I buy them a treasury bond. So this is my gift to them. Instead of maybe buying them just toys, but I buy them a toy and maybe a treasury bond. And this is saying that, within a certain amount of time, this bond, let's say if it's a $50 bond and I bought it for $25, within a certain amount of time, it's going to be worth $50. And then they'll be able to cash that in. So that can be seen as a bond. And then we have mutual funds. So a mutual fund is a pool of funds from multiple investors and can include multiple types of investments. So with the mutual fund, this can be a mix of stocks and bonds and physical assets and things like that. But it is a pool of funds. So multiple people invest into mutual funds, which means it also helps to lower risk. So lower the risk of somebody just losing all of their money because there are multiple people invested in it. And then we have cryptocurrency, which is the digital currency that can be used to buy goods and services. So you've heard of Bitcoin, Dogecoin, or Dogcoin. And I always forget how exactly it's pronounced. There are lots of cryptocurrencies out there, but of course, Bitcoin is the big one that everybody likes to talk about. So that's another type of investment. Yes, Suzanne?
I made a mistake.
So physical assets. So this can be seen as a physical item with value that increases over time. Some examples that may be included are art, real estate, collector's items, and things like that. So real estate, we're talking about like houses. Those are, but the real asset part of this is really talking about it having some value and also with it increasing over time. So those are physical assets. Those can be seen as investment types as well. That's why people like to purchase homes, because the hope is that at some point my home will start to pick up value and eventually I will owe less than what my home is worth. And that thing in the middle, that amount in the middle of here, that is called equity. So it is the amount of how much a asset is worth minus how much you may owe on. So if I have a house and my house is worth $150,000 and I owe $100,000 on it, that equity in there is going to be seen as $50,000. But that physical asset's worth is $150,000. And then something that's important that I don't think I included on here is diversification. This is a word that you'll hear when you really get into investments and you start to talk about that. So diversification essentially says to not just put all of your money in one basket. So all of your money in just one investment type. So you don't want to necessarily I just want to invest all my money in stocks or all of my money in cryptocurrency or all of it in bonds. So with that, that's why a lot of people invest in mutual funds. So mutual funds, they look at investing in all different types of investments so that if one investment goes down, like let's say I have, 100% worth of money, and then I have 40% invested into stock, 30% in bonds, and 30% in cryptocurrency. So let's say my stocks are doing really, really well. They're up, it's looking good, but my cryptocurrency has took a turn. If I had all of my money invested in cryptocurrency, I would be really, really sad and upset because now my money, I'm seeing it dwindle away or I'm seeing it go away. But because I have 70% of the rest of my income invested in something else, If those are strong, then I'm not going to be as upset because of that diversification. You know, that's what it means to not really put all of your eggs in one basket. All right, and then banking and you. So let's say, you know, you listen to this presentation and now you like, well, I mean, how do I get an account started if you don't already have an account? So with starting a financial account, if you are 18 or over, usually you can start a financial account by yourself. If you are under 18, you're usually going to need a co-signer. And sometimes even if you're over 18, depending on the financial institution, they may require a co-signer for that account still. So in order to start that account, you need a state ID or driver's license, as well as your social security number. When you go in, you sit down with someone, and then you'll start to go over, you know, opening up an account. You can also open up a lot of accounts online and start your accounts online, so you don't necessarily have to go into a branch or a physical location rather. And then what will happen? So after you sit down and they pull up your information, they're going to go over your credit report, look at what's on there, or if there is anything on there. Usually at 18, you don't have anything on that credit report. And then they're also going to review your check system. The check system looks at what like if you had any other financial institution relationships, how did those, like if you close your account, or what's your standing with other financial institutions? If you close an account and you had money owed, that's going to be on your check system. And the reason why that financial institution is going to look at that, because that's going to help them to know how reliable this person is going to be. So that's why they're checking that credit report and also checking that check systems. And then, you know, when you're thinking, how do I choose my financial institution? What things do I make important? These are kind of the formulas that I ran through my head that helped me to choose my financial institution. So one, product offered. The idea is that, you know, at 18, you're hopefully not going to be in the same financial situation as you continue to grow. So does this financial institution offer products that I think I'll need? Do they offer them at a good rate? All of those different things. And then sometimes even how is the service? How do I feel, or how am I treated when I may go into this financial institution, or when I may talk to them on the phone? Customer service is important. You definitely don't want to put your money where you don't feel welcome or wanted. And then check out the reviews. So that also helps you and lends to that customer service piece. Check out the reviews on this financial institution. Are they good with their members, or, you know, do they work with you if, you know, you run into a rough patch in life or anything like that? Although, you know, we don't initially sign up for any loans or anything like that with the thought that I'm not going to be able to pay this, but that I will be able to pay it. But sometimes life may happen and you may not. So how does that financial institution help with that? And then community involvement. How involved are they in your community? If they have a location within your community, what are they doing to give back, to say, hey, we're here and we're here to help? You know, looking at that. That's important for me, because I want to know that where my money is going, they're then going to use it to invest within my community. And then proximity. This one may be important if you're not necessarily banking just exclusively online. How close are these financial institutions to you? How many locations do they have, or where can you get access to your money? Like with that co-op ATM that we had talked about. And then when we're thinking about online banking, it's super popular. Most often, you know, young adults your age, they barely or rarely enter an actual physical branch, because you can do everything online or call and get things done. So with online banking, you usually have bill pay. So bill pay allows you to send out payments to these different places that you may have bills that you send out to. So like let's say when you get your first place, utilities and things like that. Or let's say your money sits in a different financial institution than where you may have your car loan or something. You can send the bill pay to them as well, so that that bill can get paid. And then we have e-deposit. E-deposit says that you can take a picture of a check that you may receive, you know, you sign the back of it, take a picture of the front, take a picture of the back, and then they e-deposit it into your account, or they deposit that money into your account. You used to have to take the check in, give it to the teller, they run it through, and then they would deposit the money in your account. Now, there is a thing called hold, check hold. So an amount may be held on the check, but that is specific to different financial institutions. The need for a physical location is lessened with online banking, as well as most account maintenance can be done over the phone. So MSU Federal Credit Union, we have branches only in Michigan, but we have members that live all over the world. And that's because of online banking and them being able to call us and us being able to do anything that they may need over the phone. All right, and I thank you and I appreciate you all for listening to my presentation. We talked about Financial 4.0. See You Succeed is our youth accounts for high school students, as well as Dream Racer is a financial education app that you can download and learn more about money. Wallet Watch is our podcast that is, I am one of the hosts, and we have two other hosts, and you can check that out anywhere that you may listen to podcasts where we talk about personal development, financial education, professional development, and even diversity, equity, and inclusion. So do check us out, and thank you all so much for listening to me.
And thank you, Mr. Montgomery, for presenting today's webinar, Banking, and helping us explore what banking has to offer us in managing our money with a savings account and a checking account, and how these accounts help us to safely manage our money and help us to safely spend our money. And thank you, Mrs. Kohler and students, for inviting us into your classroom today for this virtual event. Also, please be aware that we will provide a PDF file of today's PowerPoint that Mr. Montgomery presented. And also we will be delivering a set of posters to your classroom, which we hope Mrs. Kohler will be able to post on a bulletin board. And these posters are called infographics. So they provide us with a summary big picture on banking. There are 3 on banking, including where to bank, preparing for the unexpected, and why you should save and invest. And then there'll also be a poster on budgeting, which we did last week. So once again, thank you, and have a wonderful day.